Greetings and thank you for joining us at FutureMoneyTrends.com. I'm here with Craig Hemke. He is the author and editor and founder of TF Metals Report. Anyone who's interested in the gold and silver markets and wants to know about the macroeconomy, you can get daily posts from Craig. He has a free site and a paid site. It's all well worth it. The free site, of course, you can't get a better pricing. And I believe the paid site's only about $10 a month. So you're talking about the best information. You're doing what you do all day. Maybe you work in the tech field or energy or whatever your daily job is. And while you're doing that, Craig is all day long researching the precious metals markets. And then he posts and lets you guys know everything he finds. So it's a great way to just come in at the end of the day after a hard day and just get a nice wrap up and see exactly what's going on with your investments. Craig, thank you so much for joining us.
Dan, thank you very much. It's an honor. That was a great introduction. I couldn't have said it better myself.
Well, hey, you're having a lot of fun doing what you're doing. You've built something amazing, started from scratch. And I mean, everyone covers your work from Zero Hedge to the SGT report. And of course, Future Money Trends, we also cover your stuff. So I got a chance to see you speak. You have a great resume in the financial industry. You found yourself with the gold bug category, which I don't, a lot of people use that as a demeaning phrase. I'm a proud gold bug and a silver bug. And I just want to talk about the precious metals today because here we wake up. Now, silver's holding up pretty well here, but gold's down. At least it was down like 18 or 20 bucks, down to the 1227 mark. But, if you want to respond, and I'll also put up the first of two charts that you sent me, and then kind of just roll from there on what's going on. Should people be worried about this new lower level for gold this morning?
No, they should not. It's acting exactly as we've been discussing the TF Metals report for the last 6 to 8 weeks, ever since price broke out back in the middle of June. Gold and silver broke some long-term trends, and you knew at some point that the way markets respond, if you use some technical analysis, a lot of times you get a breakout through a trend. Invariably, what was resistance will turn into support, and the prices will fall back to that old trend line. And oftentimes ride a trend line for a while as support before ultimately turning higher and confirming a bottom. Folks only really need to be concerned with the big picture here. Ever since the beginning of QE to infinity in October of 2012, and don't be fooled by this notion of taper. That is still continuing in the Fed through their friends and other central banks are still propping up the bond market and keeping interest rates low. But ever since that happened in October of 2012, there's been a tremendous divergence between the growth of the Fed balance sheet, the growth of the money supply, the growth of the stock market, which is pumped up by that same money, and the price of gold, which has been driven down counterintuitively from $1,800 down to today's below $1,300. In doing so, what happened that was not anticipated by the big banks and the central banks was a tremendous increase in the demand for gold. That demand for gold has nearly liquidated the supplies to the West. We're told by several very close sources in London that the vaults of London are empty. They used to be full of 26, 30 million ounces of gold, and it's all gone. And so what you're seeing now this year, and what's reflected in that first chart we put up, is a trend that's been trying to be enforced by the big trading bullion banks of keeping price down. The black line on that chart shows you that's a trend line that connects back to May of last year after the initial beatdown of April of last year. And they have tried to keep price below that line in order to control sentiment, because in the West, sentiment is what drives investment demand. And there's no gold left, and so they can't have investment demand. You can see all through the spring price was enforced below that line, but we blew through there in the middle of June and broke that line. Ever since then, I've been warning folks on my site that price is going to come back down and, as I said, ride that line as support. And that's exactly what has been happening. This price kind of got away and rallied up to 1345 in July. They've been jamming it back, trying to get it back below that line. 1280 has been consistent support now for over a year. It's supporting it today. That line is now down around 1270. I don't think they're going to be able to do it. Eventually, price will turn, will rally as we go through the remainder of this year. And that will only draw more and more interest and exacerbate the problem for these banks. I'm very excited to be buying gold here for all of the reasons we talk about, insurance and protection. I think you should even really be buying it as a trade. There's a lot of fiat money made going as we go through the rest of this year. Same thing in silver.
With silver does seem to be holding up rather strong. Now, there's been some volatility in the gold market, but I think a lot of people forget that, percentage-wise, this volatility isn't that bad. I think just everybody's got this post-traumatic stress where, we went to 1900, then dropped to 1600, and then we couldn't go below 1500, and then we went to the high 1100s. And same thing with silver, went to 30, couldn't go below 26, and definitely couldn't go below 22. And it looks like they're holding up. So for the remainder of 2014, are you still forecasting and you still see in place higher prices for the metals?
I was I don't know if there's really anybody else back in December of last year saying that weakness then was going to be a double bottom, not a plunge to new lows. I've been right so far this year, and I still say that that's a double bottom below 1200. Beginning in January, I said, so my goals are for 2014 are a resumption of the bull market and about 25% gains in both gold and silver, which would put things back up to where they were in April of 2013 before this really, before the bottom dropped out on purpose by the banks. I put us at around 1,500 for gold and about 26 for silver. I'm not changing that forecast in the least. We're down, and the reason we can't go lower, the banks, the central banks, the Bank of International Settlements, sure, they'd love to have gold go down even lower because it's a competition to their fiat currencies, and the rising gold price makes their fiat currency look worse and worse and destroys confidence in their fiat currency. But the problem that they have now is we're down below the cost of production in some of these metals, silver in particular. And at $19 silver, the reason why price keeps bouncing off of that is it's much easier, much more simple for you and I and everybody else to mine silver directly out of New York or out of London than it is to mine silver out of Mexico and Peru. But you don't have to go through the hoops and the regulations and all the agencies and the unions and everything else. You can just simply buy and take delivery out of London if you want at $19, and that's a lot cheaper than it is to pull it out of the ground. And so that is going to continue to be a floor. Charted silver looks great too. And again, nothing has changed my forecast. I still got 4 months to go, and I think the fall is going to be pretty eventful. So we'll just see where we go from here. But I've got an inkling that anybody that has the courage to step up and add to their stack on a day like this is going to be richly rewarded.
Yeah, it really is a no-brainer when you think about it. When you just step back and get rid of all the noise. Look, you got this shiny, beautiful American Eagle or whatever it is, and that goes for all of them. I mean, whether you're buying silver, gold, platinum, or palladium, and you got to just sit back and kind of laugh because you're like, wow, I own this beautiful coin, and I've got it for less than it took these mining companies to actually get it even out of the ground, much less refine it. Okay, so let's go to the second chart you sent me and talk interest rates because the Fed is basically nothing has changed. It's all the dovish policies are fully in place, but I'm definitely reading these hawkish headlines. Again, the Fed is talking like they're going to do something, but nothing really is happening, right?
And that's all just spin. There's really no way that rates can be afforded or can be allowed to go higher. The U.S. government has already shortened maturities on their existing debt as much as they can down to under 4 years, and they've dropped rates as low as they possibly can. The line item on the annual budget of the U.S. for interest on the debt is about $375 billion, and that's as low as they can get it on the accumulated $17 trillion. If rates were to normalize, as CNBC talks about, and as you hear out of Jackson Hole, if we go back to something like 4 or 6%, the interest on the U.S. national debt would go to $1 trillion. Not just the budget deficit itself, just that line item would be $1 trillion or more. And that just speeds up the Ponzi and would require more and more money printing. This notion that the Fed is going to exit and normalize, it's all just spin. It's all nonsense. Rates are not going to be going higher. And so that second chart that you see is a plot of the 30-year long bond, we call it, the 30-year U.S. Treasury bond. It's gone this year in yield from 4% down to 3.25%, completely defying all of the experts out there, though it's exactly as I've been predicting would happen. And right on top of that chart is the price of gold. Now, you would expect those to be closely correlated because negative and low interest rates is a bullish scenario for gold, which doesn't pay a dividend. Then you can see over the life of that chart, which is just 9 months, but you can see every once in a while a disparity develops where gold gets ahead of the bond price or the bond price gets ahead of gold. But usually within a couple of weeks, it reverts some kind of mean and overlap again. Well, as I mentioned earlier, there is a big scheme to try to drive price of gold back down. It really got kicked in this time when we were at 1345 back on July the 10th. And if you look at July the 10th on that chart, there was a direct overlap, a direct correlation between the price of the long bond and the price of gold. But since then, look at what's happened. The long bonds continue to rally, interest rates continue to fall. The gold has been jammed lower. Relative between the two, what is gold, $100 undervalued or something like that?
Uh-huh.
If gold were to be $1,400, there'd be all kinds of money flows into it, and the banks would be have to print even more paper gold to try to control it. That gap will close one way or the other, and gold will rally from here on further lower interest rates. That's just a matter of time, and it's just another fundamental reason why gold at 1277 or whatever it is we record this is a tremendous opportunity.
Craig, thank you so much for joining us today. TF Metals Report, everyone. This was a short update. We'll try to get Craig back on in a few weeks or so. Certainly towards the end of the year as events unfold. I mean, there are just so many catalysts out there for gold to go up. It's really now just kind of a matter of buying, taking advantage of the opportunity. Craig, real quick before I let you go, the overall market, it has every reason to crash. The only problem is everyone is now predicting a crash. I was wondering, what are your thoughts on the market? Do you think the Dow is headed to 18,000 or you think it's headed to 16,000?
Sure, why not? If you look at the last 3 years, it's been just a nonstop up channel, regardless of geopolitics, regardless of bank failures, regardless of this crisis or that. And it's because the Fed continues to print money every month, hand it over to their primary general banks, and then they go out and flood the derivatives market and buy S&P futures and everything else, and keep jamming it higher, all in the name of the wealth effect. A day is coming, a day of reckoning is coming, because it's all built on a foundation of lies. But in the meantime, why the heck wouldn't you expect it to keep going? Why not have some money in the stock market and the U.S. equity market, and then just take some money out of it, lock in your gains once a quarter, and go buy some more precious metal with it. If you don't find the Fed, and they're going to keep printing money, and so even without fundamentals, sure, why not? Why won't the stock market keep going up? They'll probably just keep working until it doesn't.
It's funny because you and I know the numbers behind the unemployment numbers, but then I occasionally, like every other month, I might have this weird feeling of eating some cereal while watching like TV for a minute, and I'll just watch and they'll just have these stories about how the recovery is fully in place and fully under the way, and it's like, oh my gosh, like so many people are suffering out there. I mean, look at this thing in Ferguson. It's not because a cop shot one guy that these people are pissed off. These people are pissed off because the inequality is just going larger and larger. But anyway, hey, I told you 10 minutes. I've got you almost here around in the corner for 14 minutes. So hey, thank you so much for your time, and I look forward to talking to you again soon. Thanks, Craig.
My pleasure, Dan.